So you want to buy a home, but you have no idea where to begin. You're probably asking yourself questions like, how much income do I need to have? How much in savings do I need to have? What kind of home loans will I qualify for? Don't worry, I'm here to help. My name's Jordan, I'm a local Charlotte realtor, and I'm here to answer all of your questions in this video today. Step one in this process is going to be to determine what your needs are for your future home. We need to figure out what your life is going to look like in the next 5 years or so to help you decide what is a need versus what's a want for your future home. For example, if you're planning on being married and having your first child in the next 5 years, you probably need to consider a 2 or 3 bedroom home. Whereas if you're planning on remaining single for the next couple of years, you probably only need 1 or 2 bedrooms for a guest room or an office. Once you've determined what your needs list is, my recommendation is going to Zillow, Realtor.com, my website, and filtering out homes in the areas you want to be in that fit what it is you're looking for, and then looking at what the prices are of those homes and how much they're selling for so you know just how much you need in order to buy. The second step in this process is going to be to figure out how much income you need to be making in order to buy the home you want. When qualifying for a home, the bank is going to look at a couple of different things. They're going to look at your income, they're going to look at your credit score, and they're going to look at your debt to income ratio. What is that? Your debt to income ratio is going to be the total amount of money you're spending each month paying reoccurring debts divided by your monthly income before taxes. When a bank is looking at your debt to income ratio, regardless of who your bank is and what type of loan you're getting, most banks aren't going to allow you to purchase a home if your debt to income ratio is any more than 42%. So how do you calculate what your debt to income ratio is? The easiest way to do this is going to be to take your pre-tax monthly income, multiply that number by 0.42. Whatever that number is that just came up on your calculator is going to be how much money the bank will be okay with seeing leave your account to pay reoccurring monthly debts, including your new mortgage, each month before they determine that you're too big a financial risk to actually lend to. So let's say, for example, you make $6,500 a month before taxes. You're going to take $6,500, multiply by 0.42, and that's going to give you $2,730. Again, this $2,730 is the most amount of money the bank is going to be comfortable seeing leave your account each month to pay all of your monthly debts for things like car payments, student loan payments, minimum credit card payments, child support, alimony. If you've co-signed a loan, that number is going to be included in this calculation, plus whatever your new mortgage payment is going to be. So you're going to take this number, here in our example, it's $2,730, and you're going to subtract all of your current payments. In this example, we're going to assume you have a $450 car payment. We're going to assume you have a $275 student loan payment, and a minimum credit card payment of $65 a month. So when you add these together, you get $790 in revolving monthly debts. So what you're going to do is you're going to take $2,730 minus $790, and you're going to end up with $1,940 left. The bank at this point has determined that this is the most amount of money that you can spend per month on your mortgage with all of your other debts before you become too big a financial risk. Now, I know what you're thinking. You're probably thinking, but I pay $2,300 a month in rent, and the number I just got is less than that. The reason that is because when a landlord or a rental company rents to you, they know that if you don't pay, they can just evict you and have a new tenant in within a couple of days or maybe a couple weeks at most. However, if you default on your loan, the bank now has to go through the eviction process and then has to sell the home off in order to recoup their losses. So evicting somebody from a home that they've bought is a significantly more time-consuming and expensive process than it is to evict a tenant and put in a new one. This is why most people, when they go to apply for a home loan, are denied even if they're paying more per month in rent than it would cost for them to buy in the area they're living in. So your debt to income ratio is going to be extremely important. This is also why you'll hear lenders telling people to pay off their car or to pay down $5,000 off their credit card before they can be approved for a loan. It's because of their debt to income ratio being too high. Now that you know how much a bank would be willing to give to you for a monthly mortgage payment, the best way to determine how much actual loan you can get is going to be to go to Google. So what I recommend is pulling up Google's monthly mortgage calculator. And then what we're going to do is we're going to play with the numbers a little bit until you get an outcome that shows the monthly mortgage payment in which you'd be approved for. For this example, I'm going to stick with the person who's making $6,500 a month pre-tax. The interest rate, I'm going to put in 7.25% because that's right around where they're sitting today. If you're watching this at a later date, just Google what they are for today in your state and plug that in. You can put in whatever your credit score is. I've put in 760 to 779 range. For the down payment, your down payment is going to depend on what type of loan you're getting. If you want to use an FHA loan, put in 3.5%. If you're going to use a conventional, put in 5%. If you're thinking of using USDA or VA, put 0%. For your yearly property taxes, we're going to assume here for this example that you're buying in Mecklenburg County. Based on a $250,000 home price, your property taxes are going to be $1,183 a year. Okay? Google automatically filled in $875 for home insurance annually. If you think yours would be a little bit more, increase that value. Next thing you're going to see is private mortgage insurance, or PMI. If you borrow more than 80% of the total home value, aka you're putting down less than 20% on the home, the bank is going to charge you PMI monthly. This is going to be a fee essentially to mitigate their risks, because now the bank is over leveraging themselves by allowing you to borrow more than 80% of the total home purchase price. Whatever the private mortgage insurance that Google has plugged in, it'll auto generate. It's probably fairly accurate. You can leave that alone. But right now I have a lender who has a loan program that would allow you to buy a home regardless of whether you're VA, USDA, conventional, FHA, doesn't matter. Stipulations: you can't own a home at the time you apply for the loan. There is 0% down payment, no PMI, meaning no mortgage insurance payment for putting down less than 20%, and up to $5,000 in closing costs covered by the lender. And you'll see when you start playing with the numbers how much no PMI or closing costs covered can actually help in purchasing a home. Going back to our example, with all of these numbers in place, a $250,000 home is going to equal a $1,928 a month payment. So for my guy or my girl here in this example who's making $6,500 pre-tax a month and has $790 in reoccurring monthly debt, they would be qualified for a $250,000 home. And depending on where you're at, that may or may not get you a home. Thankfully, here in Charlotte and the surrounding areas, you actually can find homes for $250,000 that are safe and livable. You're going to be looking in Concord, Kannapolis, Gastonia potentially. There's a couple other areas within 45 minutes or so drive of uptown Charlotte, so it's very much doable. It's just a question of, are your needs going to be met with a home that's worth $250,000? If the answer is yes, fantastic. Go ahead, give me a call. I can help you out, right? And if not, that's totally okay. It just means that one of a couple things needs to happen. You need to find a way to pay off some of your debts so you can get your debt to income ratio lower. You need to find a way to increase your income, or maybe it's going to be increasing your credit score. So now that we've determined what your needs in a home are, I've helped you figure out how to calculate your debt to income ratio, and I've shown you how to use Google's monthly mortgage calculator to help you determine how much of a mortgage you'll actually qualify for based on how much of a monthly payment you'll be qualified for, we can now talk about how much it is you need to save to buy this home. As most of you probably know, there are going to be certain upfront costs that have to be paid in order to purchase a home. Again, unfortunately, there's no exact magical number I can tell you that you need to have in the bank in order to get qualified. That said, there are formulas and certain guidelines you can use to help you figure out how much it is you personally need to save in order to buy the home that you want to buy. Here in North Carolina, when you're purchasing a home, you're going to have 2 deposits that are due within 1 week of going under contract. One of the things you're going to negotiate is an inspection period or a due diligence period. There's a fee associated with this due diligence period, which is a way for sellers to know that you as the buyer are serious about buying the home and for taking their home off the market so you can complete any inspections you need to. This due diligence fee, while a negotiated amount, is going to be due the same day you go under contract or potentially the next day if you go under contract really late at night. The second fee that you're going to pay as the buyer is called an earnest money deposit. Now this will act as liquidated damages for the seller if you back out of the contract after the end of the inspection period or the due diligence period. You can back out of the contract for any reason or no reason at all during your due diligence period as the buyer here in North Carolina. However, you're not going to get the due diligence fee back. Now, if you back out of the contract before the end of your due diligence period, you will get your earnest money deposit back. If you back out of the contract after the end of the due diligence period, however, you will not get your earnest money deposit back, and that will also go to the seller. The general rule of thumb for these 2 fees is they're going to equal a combined total of about 1% of whatever your total purchase price is. Again, sticking with our example, if you're buying a $250,000 home, assume you're going to need about $2,500 to pay both of these fees. That's not exact. Again, these are negotiable. It could be less. However, general rule of thumb, you're going to want 1% in the bank account. During your due diligence period, you're going to do your inspections and your appraisals. You're going to need about $500 for your inspections and about $500 for your appraisal. The bigger the home you're purchasing, generally speaking, the more expensive that inspection is going to get. However, $500 to $600 is what you're going to look to spend on a average sized home. And $500 for the appraisal. Again, it can vary a little bit, but that's going to be your average. So you're going to need 1% of the purchase price for your due diligence fee and your earnest money deposit. You're going to want about $500 for the inspection and about $500 for the appraisal. The next thing you're going to have are your closing costs. These are going to be for things like the attorney fees, doc preparation fees, prorated taxes for the property taxes for the year. If you're buying a home 6 months through the year, the seller is going to be charged for the first 6 months of the year for property taxes. You're going to be charged the second 6 months, right? So you're going to have prorated taxes included in those closing costs. Closing costs can vary significantly, and again, some lenders will offer lender credits to help you cover those closing costs, like my lender does. Sometimes you can negotiate with the seller and have the sellers give you a seller credit to help you pay some of those closing costs. So your closing costs could be $0, they could be $5,000, they could be $10,000. I've had clients who have had negative closing costs when we get to the closing table. Now, no, the attorneys did not turn around and cut them a check. However, it did mean they didn't have to bring any money to the table. So what I would recommend is going to be plan to have $1,000 in closing fees for every $100,000 you're spending on the home. So in this example, with a $250,000 home, assume you're going to have $2,500 in closing fees. The last fee you're going to have is your down payment. So again, going back to loan types, conventional loans, generally speaking, you're going to need 5% down. FHA, you're going to need 3.5% down. And then with VA and USDA, typically you can do 0% down. Or if you have a special program like what my lender is offering, you could end up putting 0% down. So what does this look like in practice? If you're using a conventional loan that requires 5% down, you're going to need $500 for your home inspection, $500 for your home appraisal. You're going to need $2,500 to pay your due diligence fee and earnest money deposit. We're going to assume $2,500 for closing costs, and then you're going to need $12,500 for your down payment, bringing your total costs that you need to have in a savings account to complete this transaction to $18,500. Now, if you take that same home, but let's pretend you're using an FHA loan, which only requires 3.5% down, and you were able to negotiate with the sellers and they agreed to cover $1,500 of closing costs for you, you're now going to need $500 for your home inspection, $500 for your home appraisal. You're going to need $2,500 for your earnest money and due diligence. You're now only going to need $1,000 roughly for your closing costs, and your down payment is now $8,750, bringing the total amount you're going to need in your bank account to $13,250. Let's take it a step further, and let's say you were to use a 0% down program like what my lender is offering. You're going to need $500 for your home inspection, $500 for your home appraisal, and you're going to need $2,500 for the earnest money and the due diligence fee. That's it. Meaning, in order to buy that $250,000 house, you're only going to need $3,500 in the bank account, roughly. Again, I am not a lender. I am a realtor, okay? So depending on who your lender is, what home you're buying, and where you're buying, these fees can look different. This is not an exact science. However, hopefully, going through this video, using the calculations and the tips and the tricks that I've given you here, you'll be able to guesstimate roughly how much it is you'll need for a down payment, how much you'll need in savings, how much you'll actually be approved for based on your current earnings, credit score, and debt to income ratio. And now you have the tools and knowledge needed to make adjustments in your lifestyle to help you get to where you want to be faster. If you have any other questions, or if you have any other suggestions for video ideas that you would like to see come out, please feel free to leave them in the comment section. And while you're down there, if you would hit like and subscribe for me, that would be a huge help. And if you ever need anything, please feel free to reach out. I'll see you in the next one.